Welcome back. You know, it's clearly important to make sure that you're watching your 401k, but you may actually need more than that for your retirement. We've got the man with the plan right here, our financial pro, Mark Triplett, here to tell us about why you shouldn't just stop at only your 401k. And so I guess where I would start here, because it can be really complicated to understand 401k, especially for people starting out. So why might the 401k alone not be enough for retirement anymore?
So a 401k can be a great place to start. Many workplaces have a workplace retirement plan, whether it's a 401k, 403b, or some other type of plan. And you can payroll deduct out of it. It's a great place to have that money go towards your future before it hits your bank account where you might be able to spend it. However, with rising cost of goods and services, inflation, rising healthcare costs, many folks might not be saving enough. And if they started late or they're inconsistent on their contributions, they might wind up with not enough put away to maintain their lifestyle later.
Okay, and do we think that this is going to be a long-term problem? Will we ever get back to the point where we'll just be safe with the 401k that we already have?
I don't know if I can answer that question outright, but I would say this. Most folks, they really should take inventory of what it costs to maintain their lifestyle today. We call that the spending plan or the budget, and extrapolate that out for inflation, healthcare, and taxes. And then we can start to determine, what are we going to need for retirement resources? Maybe that 401k or IRA or other IOU to the IRS. Maybe a Roth account where it's tax deferred and comes out tax free. Maybe Social Security or pension if you're fortunate enough to have one. And once you have an inventory of that, then we can just start to have that conversation about how much should we contribute to the 401k. Is it too much? Is it too little? Should it be saved in the pre-tax side or should it go to the Roth side? So many different variables here that I think are done without a clear lens of what should be done.
And I want to kind of, you touched on it there, but what are some of the most common mistakes or even misconceptions out there that people have when they go throughout this whole process with their 401k accounts?
One of the biggest mistakes that we see is not contributing enough to take advantage of the employer match. If your employer is matching and you're not contributing at least the amount to max that out, you're leaving money on the table. The other is either being too aggressive or too conservative in their investment options, and that's done oftentimes in a vacuum where they haven't really considered how that 401k is going to interact with other retirement resources, both income and assets. Lastly, I would just say that folks don't rebalance frequently enough. They kind of tend to treat their 401k like a crock pot. They set it, forget it, walk away, and don't really stay on top of it.
I think that's really the most common thing. And I mean, I know even when I was starting out, that was pretty much what I was told by people. You get it set, you kind of go back and look at it every once in a while, but just kind of set it there. That's not what you want to do, right?
Now, we recommend at least checking it out once a year, doing rebalancing. We prefer that our clients are doing it quarterly. In fact, one of our services, 401k Maneuver, actually rebalances it for them, kind of like an update to their iPhone. They just automatically, we take care of it for them. But that way they're making adjustments because you're making contributions consistently, hopefully by payroll deduction, but economic environments change, market environments change, and it's good to be on top of that and making adjustments along the way.
So I want to talk about our younger people who are getting started with all of this. What should they be doing right now to try to get the most out of their 401k?
The best thing to do is start early and be consistent. Even if it's a small amount of your payroll going into this plan to be deducted for your future, that adds up over time and compounds or could compound to great results over time. So just being consistent and starting early, and then making sure that you're also looking at what other retirement resources might you have or where might you need to be saving in addition to your 401k.
It might be too early to say this, but do we envision that here in the future, maybe we're going to need even more than what we have right now when it comes to just saving up? Are we going to have to pile more on top of what you're already saying?
So it all depends on lifestyle. There was a fad a few years ago of knowing your number. Really, folks need to take an inventory of what their lifestyle costs. We've had folks that walk into our office, they have a few $100,000 and they feel like they're not going to run out. But with their lifestyle, we find that it's manageable with their income sources and assets, that they can maintain that comfortable lifestyle that's comfortable for them. We've had folks that walk in with multi-million-dollar accounts, and we know they're going to run out because their spending is so great. And when you inflate that out for taxes, inflation, and healthcare, they're just going to run out of money. So it's not about how much you have in the account as much as it is your lifestyle, and are you saving enough and having enough retirement resources to get you to and through retirement for your comfortable lifestyle.
Very, very good advice. If anyone's trying to get any information, obviously you always give us good advice. Where can they find you?
Just check us out online. Triplett-Westendorf.com. There's a lot of great information out there at no cost.
All right, Mark Triplett, I appreciate you, sir.
Thanks for having me.